Here is a detailed explanation of the concepts that I utilize for my trading strategy. So hello traders, let's look at the strategy that I utilize for all my trades, and the three important concepts that I utilize are the inducements, lower time frame confirmations, and key time windows. So these three are like my non-negotiables. So even if one of them doesn't align, when I place the trade, I will not take any trades. When I'm looking for trades, and if one of them doesn't align, I will not place any trades. So these three are my non-negotiables. Although there are certain other ideas I can include along with these three concepts, which I can get more higher probable trades, but these three are the key ones that I always look for before placing any trades. So let's look at how these three concepts work together. So first, let's say price action does this movement here, as you can see. So here we have equal highs, here we have equal lows. So equal highs. So pattern traders will be thinking that these levels are to be respected at the highs and the lows, and there will be a lot of stop losses involved. Not just pattern traders, but there are many other traders as well. They'll put a lot of stop losses here and enter the trade because they think these levels are to be respected. But here is where inducements play out. So inducements are basically smart money concepts or smart money sweeps, but they are different because inducements are a lot more volatile, they are more meaningful, they show intent, and they have a lot of aggressive price action going on with them. So I'll explain what I mean by this. So let's say price action did this equal highs and equal lows here. A lot of stop losses run on top. So for example, let's say price went high, swept high. So now what we can see is that all the stop losses have been taken out right over here. So now this is the action of enticing people to get into a trade and then later take them out. That's essentially the inducements or smart money sweeps. That is enticing people to get into the trade and then later taking them out. So it's like basically laying out a trap. So here market does a bullish move and takes out all the stop losses on top of this resistance level, and then after that what we see is that a lot of buy orders will be involved because a lot of traders will think that since this is a bullish breakout structure, it's going to be a buy opportunity and market will be going bullish in the foreseeable future, so they will place a lot of buy orders here. But then what happens is that market reverses back like this and then takes out all the buy orders as well, buy stop orders as well, and essentially gives us an internal breakout structure. So if there will be a lot of candles involved in this thing, here there will be an internal breakout structure, and even if possible price might do a full breakout structure right over here, or it might even induce this zone to go even higher. So there's a lot of possibilities going on with this thing, but essentially what we are looking for is aggressive price action. So instead of price doing a small build up like this, uh, price doing a build up like this, and then price sweeping this trend line like a very minor sweep and then slowly consolidating downward, like it's going to take a lot of time. These type of price actions, these are liquidity sweeps and not inducements, right? So this is like the main difference between inducements and sweeps. Sweeps are not as meaningful as they don't happen in our key time window. So that's the thing. Inducements are more likely to happen at key time windows. It doesn't mean it's going to only happen in a key time window, but it's more likely to happen. It's less likely to be manipulated in our key time windows. So that's the concept of inducements and liquidity sweeps difference. All right. So now we are going to check for lower time frame confirmations. So here, first for lower time frame confirmations, first we will verify whether we are in our key time window. So let's say this is the Asia range right over here. Uh, yeah, this is the Asia range right over here. Okay, price did a build up of liquidity on top, and then Frankfurt Open did an inducement like this. Frankfurt Open did an inducement like this, and then price retraces back slowly like this. Now, after price retraces back, London opens around this region. London opens in the first hour. That is my London key time window is the first hour of London Open, and the another key time window is the New York second hour open. These two are less likely to be manipulated, so I trade in these regions and I don't place any trades in other regions. So once price retraces back here and once London opens, price shoots up and taps in our key refined zone, because this was a meaningful inducement, because price aggressively took out all the stop losses right over here and aggressively came down as well. So that's why this is an inducement. So this is a refined zone on the Frankfurt session, And then when once one London reaches this refined zone, we could look for sell orders right over here, sell possibilities. And there's also another way this could play out, and let me just show you. Here, let's say we are in the same Asia range right over here, and then Frankfurt opens and doesn't give much of a reaction, but it's a minor bullish reaction. And now London opens in this region, right? And once price action reaches here, and London does a inducement of the Frankfurt open stop losses as well as the Asia high stop losses. So London took out all these stop losses right over here. And now, and this was a very volatile price action. Keep in mind, this should be a very volatile price action. So we saw the cause. Now we need to see the effect. It's like the law of cause and effect. So the cause, now the reaction will be a volatile price action downward. So we're going to see a volatile price action downward with an internal breakout structure around this place or a full breakout structure as well, depending on how price action plays out. After that, price will, since we have an internal breakout structure, we will look for the candle or the set of candles which led to this internal breakout structure right over here. So now, since these are the candles that led to that internal breakout structure in this region, we will mark out this refined zone for which we can look for price to tap into this region, and then later place sell orders, and then look for price going down in a bearish reaction. That's it. So this is the lower time frame confirmation after an breakout structure, after an inducement has been done, after it showed a breakout structure or an internal breakout structure. We will look for price to come into our refined zone slowly, and then if it happens quickly as well, it's more preferable, but even if it happens slowly, it's fine. And then once price taps into this region, it will give another volatile reaction like so. So this is the lower time frame confirmation. We look for a breakout structure indicating a shift in price action, especially in M1. So this is all happening in M1. The analysis of all the strategies or the trading strategy or the concepts that I utilize all happen in the M1 time frame. So scalping basically. So we are looking for an M1 shift, M1 internal breakout structure or an M1 big breakout structure. So that's the thing. So inducements has been done. Lower time frame confirmation, as I explained, that has been done. And key time window. So key time window, this is the London Open. So we look for London Open and trade within our London Open. So past London Open, we do not take any trades because it's likely to be manipulative. And I mean, apart from the key time windows I mentioned, other time windows are more likely to be manipulative, and I don't take any trades in those regions. And finally, for my take profit. So take profit, essentially what the protocol I follow is that once price action reaches around 1:2 or 1:3, I move my stop loss which was here to my 1:1 risk to reward ratio, which is around here, let's say. So I place my stop loss here. Price came to 1:2, 1:3, let's say. I'll move my stop loss at 1:1. So price will slowly retrace back and then go down, should show that kind of price action. So this is basically the break even protocol. So I break, even if I lose the trade, I will still break even, I will not lose any money. So that's the risk aversion of this strategy. And then after that, once price reaches 1:3, I will sell half the lots and then get half the profit and leave the remaining price based on the scenario. So let's say only the trinity aligned, that is these three concepts aligned, then I won't look for 1:10 risk to reward trade. I will look for at least Asia low, or based on the scenario, either Asia low or the nearest point of interest, and depending on that, I will sell the remaining half of the lots at a specific risk to reward ratio. But if it was a high probable trade, let's say, and if this was a point of interest, let's say we tapped into our point of interest, we induced Asia, we induced Frankfurt, we also tapped into a supply zone right over here. So this is a very high probable trade, and price gives us a bearish reaction, and it did a internal breakout structure. And as you can see, we wait for lower time frame confirmation because we are in a key time window. Inducement has been done, a lot of liquidity has been taken as well, and now we look for sells. In these types of cases, I will look for 1:10 trades or a new breakout structure at the low. So if this was a demand zone, if there was a demand zone right here, I might look to sell till this demand zone or even past the demand zone, so making an external breakout structure. So this is essentially the three concepts of how I'm utilizing these three concepts. And now there are a little bit more certain other ideas that I can utilize, but these three are the essential ones. I don't trade if even if one of them doesn't align in any other trades. So yeah, that's about it for me.